right. So let's look at Chapter 5, okay? Let's go to Student View. All right, and let's look at the static problems. All right, so again, we're back at Nicole's Getaway Spa, okay? So Nicole's Getaway Spa continues to grow and develop. Nicole is now evaluating a computerized accounting system and needs your help in understanding how source documents inform accounting processes. She also needs some help reconciling Nicole's Getaway Spa bank account, all right? So look at what we've got going on here. Now, if you missed looking at that visual on how accounting processes work and the documents and everything that are initiating these transactions and things, you missed a lot. Go back and look at that again, because you may never know when something might show up. So it says, for each source information shown below, prepare the appropriate journal entry. Now just realize, though, here's real world, okay? Real world is going to run something like this. As we are keying in the invoice and we, email the invoice to whoever it is, our customer, there's a journal entry that's going to go in behind that invoice. So a lot of times in modern day accounting software and stuff, you're not really keying in all these journal entries because it knows, okay, I'm billing the customer and, we need to be recording sales and we need to be recording accounts receivable. So there's a lot of that kind of stuff going on in a modern day system. But just realize that, again, I cannot overemphasize this enough. If you sit down to an accounting system, it's only going to allow you to screw it up faster, because if you can't picture what's going on behind the scenes, you're going to have a problem, okay? So let's take a look. We've got A, B, C, and D. Now again, I like to start down here in the input area, but just realize that if you're sitting there and you're reading something and you're like, I feel like I need more information, just scroll up to the top where the narrative is, and a lot of times there's, a little something up there that they may have forgotten to drop in down here, okay? So in item number 1, we've got a purchase order dated October 13th, 4 massage chairs costing $765 and oil supplies costing $240. Record the transaction, okay? So what do we get? Okay, we got to vote for equipment. Okay, we got to vote for supplies. I haven't heard the right answer yet. This is my only imitation. Any of y'all do the Lion King? Y'all know the Lion King? Rafiki? That's all. This is my only imitation, so you better listen quick. Lucada. Bingo. No journal entry. Okay? Why is it no journal entry? Do what? All we did was we ordered it. Okay? So understand how a purchase order works. So there is something happening in the purchasing department. Okay? And let me walk you through something that'll kind of help you get the picture of what's going on here. So let's say, for instance, I needed a new printer in my office here at Central Piedmont, right? If I needed a new printer in my office, I would have to go to probably the division chair, the division admin, and say, what form do I need to fill out to let my division director know that I need a printer? and that's typically called a requisition request. Then I would get that requisition request. I would say, hey, I need X printer, and it would go to my division chair. My division chair would sign off on that requisition request, and then that requisition request gets sent to the purchasing department at Central Piedmont. Okay, you following me? So then when the purchasing department at Central Piedmont gets that requisition request, they already, keep in mind, those folks know all the folks that they have, possible contracts with, discounts with, and everything else under the sun. And they're going to call their different places that it's like, hey, maybe they've got 2 or 3 places that actually sell this specific printer. And they figure out which one has the lowest price. And then once they figure out which one has the lowest price, then they take that requisition request and they turn that requisition request into a purchase order. The purchase order then goes to the vendor that we're actually going to buy the printer from. Okay? Then, so that's kind of where we are right here, is we're sitting in the purchasing department and we just sent that purchase order to the vendor. So again, think of it more along the lines of we just notified the vendor that we need a printer, or in this case, we need massage chairs. So nothing has changed hands here at all. Purchasing has just ordered the chairs. Okay? All right, let's look at the next one. Remittance advice from customer for $93 received October 17th. Record the transaction. All right. Now let's talk about what a remittance advice is. So I'm going to jump around on you here. A remittance advice typically comes with an electronic funds transfer. So in this particular case, right, maybe our customer, we gave them our Zelle locator and they sent us the money via Zelle, right? So now it automatically deposits into our account and we're notified of who sent that money to us. So the remittance advice is actually created, if you want to call it that, by the bank, because the bank knows where that money came from, and they're just using that remittance advice to notify us that X customer, this name, sent us this much money on this date. Okay? So when we receive that, what do you think? Good. Cash gets a good. Okay, so we've got cash there. We know it's going to be 93. We know 93 has to balance, so we're now up to a C. We got 75%. Okay, how did we know that it was accounts receivable? Doesn't have anything to do with the word receipt. You got to think harder on this one. Well, going directly into the account doesn't have anything to do with it. Because it happened from a customer, not necessarily, because this could have been, what could this other item have been? This could have been service revenue, but we're putting in an accounts receivable. Why are we choosing the accounts receivable versus the service revenue? Bingo. So the customer is sending us money for something that we've already done. So there's a little bit of a deeper thought process that has to go on there, right? Because the assumption is that we've already provided the service or the product in the past. And now we're just collecting it. Yes?
How can you assume that? There's not enough information. I would have assumed the opposite.
You would have assumed revenue?
Yeah.
Well, typically on something like this, though, how can I give you a picture of what's going on here? If it were service revenue, the description would read something more along the lines of, we made a sale to the customer, and the customer charged it on their account, provided us with a credit card, paid with cash. But it's usually going to start with, we made a sale to the customer, something along those lines. Versus here, we're focusing on receipt of the cash. So we sort of assume we've already done the work. We've already recorded the accounts receivable previously. We've already recorded the revenue previously. Okay? So watch for little things like that. Okay? Let's look at number 3. We've got a receiving report indicated October 22nd receipt of October 13th order. Now, again, remember, what did we do on October 13th? We ordered chairs. Now, remember, somebody requisitioned the chairs. The purchasing department sent out the purchase order to the company that we were buying the chairs from. Now, the chairs have shown up at the dock for the receiving department. The receiving department is going to have, imagine it like this. You've got a box that's got a whole bunch of chairs, however many chairs in it. In this case, what we got? I guess we got all of them, didn't we? We've got the chairs in it. And there's usually, and think about this one because you probably have experienced this at some point. Probably. There's usually like a form that's in some kind of little plastic package on the outside of the box. You may have ignored that before, but what's on that form that's tucked on the outside of that box? It could be the invoice, and the information that's on that invoice is effectively what's in the box, right? Okay? So you following me? So what's happened here is that the box with the chairs have shown up at the receiving department. The receiving department cuts open that little packet. They open it up, but now we're in a business environment. So the only thing on that page, the receiving advice, says there's massage chairs in here, and there's X number of them. And the folks in the receiving department try to imagine like a shipping dock, right? And the folks at the shipping dock are going to open that box, and they're going to check the count from the report that was on the outside of that box. They're going to count that and make sure that it matches. You with me? Because if that report on the outside of that box says that there's 5 chairs in this box, then when we open the box, there would be 5 chairs in the box, right? Because if the report says we have 5 chairs in the box, and we open up the box and there's only 3, there's either a second box or somebody made a mistake. You with me? And we don't want to pay for chairs that we didn't get. Okay? So all along this process, there's all these checks and balances to make sure that we're actually being billed what we've actually received. So this receiving report is actually produced, and again, this day and age, it's all electronic. It comes in, the box comes in, they say, yep, it's got this many chairs in it, and the receiving report goes to the accounting department, so the accounting department knows how many chairs to pay for. So think about how this really works. All this, what y'all a lot of times will hear called red tape, it's not that we're trying to make anything difficult, but you have to realize that the accounting department, on some level, we're kind of flying blind, and we have to rely on other people, what they see and what they do, letting us know what we need to do. So this is the kind of stuff that you end up with, okay? So the receiving report indicated the receipt of the October 13th order, also received supplier invoice totaling $1,005. So we know that that's got a balance. So where'd you want to put it before? Well, back on number 1, where did y'all want to put it? Equipment. So now this is when we're actually receiving the equipment. Right? And good. Let's see. Hang on. Oh, that's right. We did. We ordered 2 different things. And Yep. Sorry. You're right. We do need to break that out. All right. So $765 on the chairs. And we need to move this down. And this is going to get $240 for the supplies. Sorry. There we go. Good call. No, I think we got everything. Because, let's see. Yeah. Because if you get the $765 plus the $240, you actually get the $1,005. Okay? All right. So, again, if you did not really pay attention to how this business process flows through the system, make sure that you go back and look at that visual in the chapter. Okay? All right, number 4 says Nicole's Getaway Spa check for payment in full of October 13th order. So the full amount of the October 13th order was $1,005. All right, we made a payment, so cash gets that credit and good. Okay, how we doing? So definitely the biggest thing here is that notice that on October 13th, right, when we were talking about that purchase order, remember that was a no journal entry, because I'm just saying that something like that will end up in your homework, an exam, or something else, and you're going to be like, I know there's a journal entry to go there. Remember, there is an option of no journal entry because it's just not happening yet. And don't bring, I've already had this discussion with a few people at this point. Don't bring tomorrow into today, right? Because when we ordered all that stuff up on October 13th, you knew where it was going, right? It's coming in on October 22nd, and you're trying to bring October 22nd into October 13th, but that's not, don't bring that into today, okay? Any questions on that one? Okay, so make sure that you're clear on what kinds of things are actually happening and when. All right, let's take a look at this one. So Nicole has asked you to prepare a bank reconciliation for Nicole's Getaway Spa. According to her records, Nicole's Getaway Spa cash balance is $6,000 at December 31, but the bank reports a balance of $5,500. Now, a couple of things to note here. At this point, Nicole's Getaway Spa cash balance is $6,000. So right there at the very top, this is what we say is coming out of our general ledger, T accounts, accounting records, wherever you want to pull that from. Okay? And the bank says we've got $5,500. Okay? So just drop those in at the very top. So now understand, don't miss this. So if you have trouble with bank reconciliations, let's talk about really good picture to get in your head here. So we start with what the bank says. We start with what the books say, okay? Now, at this point, the next step is just to compare what detail does the bank have versus what details does the company have. And if they both have it, then it's like it's all good. The issue is that if we know about something that the bank doesn't know about yet, then we need to put it on the bank side. If the bank has something listed that we don't know about, then we update our records, right? So it's really like you and I have a checking account together, and periodically we stop in and check in with each other and say, hey, did you write any checks this week? Did you make any deposits this week? And if you did, then I got to get it on my records, right? And if I made a deposit or wrote a check, you need to get it on your records. That's all that's really happening here, okay? All right, so the trick is to know who knows about it first, because whoever already knows about it, they've recorded it, and then we're going to record it on the other side, okay? So A says the bank deducted $250 for an NSF check from a customer deposited on December 22nd. Now, a couple of things to note here. One, what is an NSF check? Non-sufficient funds. So who wrote the check in this situation? Mm-mm. Who wrote this $250 check? The customer wrote the check to us. We deposited it, and when our bank tried to run that check through to the customer's bank went, yeah, there's no money here. And they kicked it back to our bank, and now our bank is notifying us that check's no good. All right, you with me? So, who already knows about the NSF check? The bank. So we need to adjust the company statement. Remember, whoever knows about it already, they've already reflected it in their balance, and we have to reflect it in the other side's balance. So if the bank already knows about this NSF check, they're the ones that are telling us about it. They've already reflected it in the 5,500, so now we need to write it or record it on our side, or what I call the book side. All right, now here's the question. Is that 250 going to be an addition to our 6,000 or a subtraction? Good, it's going to be a subtraction. So how are we doing there? Because understand what happened. When we actually initially deposited that $250 check, right, we increased our cash balance and either recorded revenue or coded it against accounts receivable, right? So now that 6,000 is $250 too high because that check got kicked back. All right. Item B, Nicole's Getaway Spa has written checks totaling $3,500 that have not yet cleared the bank. Correct. Okay, so who knows about it? The company does, so we need to adjust the bank, add or subtract? Subtract. Okay? All right, hang on. Let's do this. All right, so think about what's happening here. We have written, remember, this is us. So don't look at it as this as a third party. We are book. Okay? We wrote $3,500 worth of checks. when we wrote those $3,500 worth of checks, we immediately deducted that out of our cash balance. So that $3,500 worth of checks is already reflected in that $6,000. So now we put all those checks into the envelopes, we mailed them out, and we're sort of in this limbo of where whoever we mailed all these checks to has not deposited them, and they have not come back and cleared our bank account yet. You following?
On the NSF check, so it was a deduction, but then you put up parentheses
Oop.
on the bank statement. So,
Yep, hang on. Actually, it looks like it's... Oh, it's handling it either way. But you're right. To be consistent, I need to put that in as a negative. But either way, it is subtracting. Yeah. You got to watch stuff like that, because sometimes when they drop something in there, if you didn't put it in and it wasn't in parentheses, it would add that. And then the only way that you would know that it was doing that is this would go from 6,000 to 6,250, not down to 5,750. Okay, so just be careful with some of those. All right, how we doing? Okay. All right, let's look at number 3. The bank added $10 cash to the account for interest earned in December. Who already knows about this item? The bank, so we need to adjust book with an addition of $10 and interest earned. Okay. All right. Nicole's Getaway Spa made a $3,480 deposit on December 31, which will be recorded by the bank in January. I'll explain this one here in just a minute. Who knows about this deposit? The company does, so it goes on the bank side as add or subtract. An add. Okay, and it's called a deposit in transit. Okay. Now, if you listen to the lecture, you've already heard this, so just go with it. So, what time does the banking day end? Haven't heard it yet. Oh, that's close. Who said 2:30? 3:30? It's actually 2 o'clock. Okay? Now follow the logic here. Okay? So what happens is banks actually run their banking day, like all the transactions and everything that are coming in and out of the bank, you know, through the teller and the online and ATM and all that. It runs from 2 o'clock one afternoon to 2 o'clock the next afternoon. Okay? Now, the reason why it does that is because everything, think about this, this makes perfect sense. The reason why is because then that gives them from 2 o'clock in the afternoon to 3 o'clock in the afternoon to balance out all the drawers, get everything settled up and all that. So it allows them that administrative time for the last 24 hours of banking time to actually reconcile everything before they leave that afternoon. Okay? So that's what's really going on there. Now, just realize that you have to be aware of that from a personal perspective for one reason. If you deposit a check a lot of times on a Friday afternoon after 2 o'clock, when is that check going to, in full, when is that check going to be available in your checking account? Tuesday morning is usually the amount of time. So think about what happens there. So you deposited it after 2 o'clock on Friday afternoon. So now the banking day gets cut off. The next banking day gets cut off at Monday at 2 o'clock. Everything goes through the system overnight Monday night, and it's ready for you on Tuesday morning. You with me? Okay. If you have direct deposit, Ah, there we go. See, I'm not going to forget about you. If you've got direct deposit, when is your check available to you? Friday. Mm-hmm. Yeah. So you're talking about getting everything together for everybody's direct deposit. Yeah. Yeah.
Is 2 p.m. for all of them? Because mine's like 6 p.m.
I'm not talking about when they're going to lock the doors.
No, I know. When I get physical checks at my job and it says I can deposit it up to 5 p.m. Friday and still get it Monday.
Interesting. Who do you bank with?
Truist.
Okay. There could be one of two things going on there. One, a lot of times, if you have like a savings account with them as well as your checking account, a lot of times they will provide that as a service, possibly. Interesting.
It says it's always available next business day, no matter what time, unless you do it after 5 p.m.
Okay. Oh, interesting. Next business day. I bank with them. I'm going to have to check that out. Okay. Mm-hmm.
Whereas everybody else that banks with like Bank of America, whoever they bank with, they don't get it until Tuesday.
Oh, interesting.
Yeah. But since I bank with Wells Fargo, I get it Monday night.
Interesting.
And he does payroll on Sunday.
See, that tells me though that internally Bank of America is doing the whole thing of cutting their day off, and they're not going to move the money over until the following banking day, versus you being at Wells Fargo may have the same kind of thing that's going on over here with Truist, is that Wells Fargo says, nah, if we see, because if you ever look at your account online, you ever notice it's like something will be up there and it'll say pending, right? They've already been notified that it's coming in, and maybe Wells Fargo says, you know what, when we see pending, we'll let you have it. It's all good. But at Bank of America, they can't do that internally because the money is either in one account or the other. It can't be in both. So it's a pending withdrawal out of the bank's account. It's a pending deposit into the other. It can't be in two places at one time. So that could be a process.
So it's kind of like the posted balance and an actual balance?
Correct.
Because my checks, it'll never be pending. It'll always be actual.
Okay. That's probably what it is that it's like they're being notified already that it's there. And of course, you do realize that writing a bad check is illegal. Huh? What? Writing a bad check is illegal. So if a business wrote a bad check, that would be illegal for them to do. Now, most people go, oh, they're just going to charge me a bounce check fee or whatever. Yeah. It's illegal. Depending on how bad they wanted to really sock it to you, or how many times you've done it, that's a whole different deal. But just realize that, you've got all those fees and everything else. So just realize that, if you've bounced a check, just realize it's like that the amount that you just bounce that check for, it doesn't matter whether it's $5, $10, whatever. You're going to get probably a $50 total charge. Anybody that you wrote a check to, so let's say that you put the check into your checking account from your employer. If you write checks on that money and then it bounces back to you, yeah, they're coming after you. Now, I will tell you, when we used to have a mortgage payment, the one payment that we allowed them to draft out of our account was our mortgage payment. But we got them to draft it out of our savings account, because in that way, I didn't have to worry about how much was, there was always enough for the mortgage payment in the savings account. I keep a very little bit in what I call my operating checking account. So I didn't want to have to worry about it. I'm like, just take it out of the savings account. And like 2 mergers later, when bank merged into bank, they conveniently switched our drafting account from our savings to our checking account. No knowledge of us, and all of a sudden, it's like I start getting phone calls and notifications and everything else that all the checks that I wrote out to Duke Power and Piedmont Natural Gas and everybody that I was banking with, dealing with, checks were bouncing all over town. And we called our bank and went, yeah, nope, you are going to fix this because you changed the account, not us. And they did. They fixed it. It was a pain in the butt for them, but it was like, I ain't doing this. You're going to tell Duke Power and everybody else that you screwed up, not me. So it can get a little tricky when you're talking about some of this kind of stuff. All right, let's take a look at the next one. The bank deducted $10 for service charges. So who knows about it? The bank. So we're going to adjust book, add or subtract. Good. It's a deduction for service charges. Okay. All right. And the last one says Nicole's Getaway Spa wrote a check to a supplier on account for $300, but mistakenly recorded it as $30. All right. Now, understand what's actually happening here. In this one, because in a fully computerized system, this kind of stuff won't happen. Okay. Because if you key it into a computerized system and you say, I need to send $300 to whoever, then $300 gets sent and everybody is all on the same page. But try to imagine this. We've got a set of a couple of manual checks that periodically somebody needs to actually type out a check and take it to somebody. We typed the check out for $300. So let's say it was something along the lines of, we needed something from a supplier, and the supplier said, yeah, you've hit your limit on your credit. And somebody came back to the office and said, give me a $300 check. So I'm going to pay off some of this balance so we can get another order going. All right? So we type the check for $300. But when we key it into the accounting system, we key it in and we accidentally drop a 0 when we're keying it in. So it's only been recorded in our accounting records for $30. You with me? What's wrong with our balance? Keep talking. Hang on. Keep talking. What do you mean we're missing $270?
Our accounting system is down $207 from what it should be.
There we go. It's $270 too high, right? So the check, we should have reduced the account balance by $300. We only reduced it by $30, right? We need that additional $270 to come off of there, right? To get it to the correct amount, right? Good. We need to reduce the company books by $270. Yeah, error. All right, how are we doing there? Okay, all right, so, hang on. See, now that one, interestingly enough, see how, I just put that one as regular 270 and it didn't balance. And I'm like, well, that's the last item. It's got to balance. I had to put that one in as a negative. So be careful with how you're keying these negatives in. Go ahead and add a little subtraction in there and just make sure that when you're keying it in, it is actually deducting it and your updated balance is going down. Okay? So at this point, we balance and we got to hit a little check my work, right? Got to get those little green check marks. Good stuff. All right. Any questions there? Because we're going to play with a couple other things here in just a second. Okay. Okay. Credit, by the way, I love credit unions. If you don't bank at a credit union, you need to go try to find you a credit union that you qualify for. Because the big thing is on credit unions, not anybody can walk in off the street and join a credit union. A credit union, you are a member of the credit union. Okay, so when you deposit money into a credit union, you have to have qualified somehow. So I'll give you for instance. A number of years ago, my husband and I, Sharon View Credit Union has a branch really close to us, and we were like, ooh, that'd be really good to bank at the credit union. We go over to Sharon View, and they're going down this list. Do you qualify? Do you do this? Do you do this? Do you do this? Da 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 da. And they went through this list, and we're like, yep, we got none of those. And the guy looked at us, and he says, hang on a minute, I got one more. He's like, are you interested in becoming a member of, it was like the Square Foot Gardening Club? And we're like, well, how much does that cost? And they said, $30, and it's a lifetime membership. We're like, sure, we'll become members of the Square Foot Gardening Club. And that was one of the ways that you could qualify at that time, right, to become a member of the credit union. But when you see things like the State Employees Credit Union, that's one of the biggest credit unions out there, like nationally, the North Carolina State Employees Credit Union. Guess what you have to be? A state employee of North Carolina, right? So I qualify for that one as well. Like the Navy Credit Union. You have to be a member or a direct family member of a military person in the U.S. military. Okay? So it's things like that. But I love credit unions. But credit unions typically, though, they function, part of the big thing with credit unions, they pay higher interest rate on their deposits, and they charge lower interest rates on their loans. That's a big reason why I love them, because they're trying to make the members happy. It's not like Bank of America and Wells Fargo and all those folks and everything. The people that they're trying to make happy are the shareholders and their executives, right? So credit unions, love them. Absolutely love them. Okay, regular banks and stuff usually have FDIC insurance. Credit unions, don't lay my feet to the floor on this one. I think it's called NUCEUA or something like that, but it's like but they have kind of like a FDIC insurance on their deposits as well. So I would start with, see if you see a branch somewhere close to your home and look up on their website and click on member information or whatever and apply. Okay, well, see, my husband and I have a old account at a credit union in South Carolina that way back in the day was a credit union that to qualify to be a member there, you had to be a textile worker in the state of South Carolina. And his dad worked at a textile mill, so they became members and set all the kids up and everything else. So, you know, I think that account's probably been in his name since he was 5, something like that. But yeah, so I love credit unions. And if you ever go to one of the other things I love about them is it's like when you go to a credit union, it's not going to be that big fancy building and the interior and everything else. Because that's not what they do. They don't want you walking in there going, why are you spending all my money on marble floors? Versus banks, that's what they do. They spend all their money on marble floors. All right. But honestly, I will tell you, my husband worked his way through college, and the beginning of every semester, he would get a loan for how much money he needed for that semester. He would work all semester long, pay off that loan, get a new loan the next semester. And he didn't have any really big high-paying jobs or anything else. Now, I will admit college was a lot less expensive back then. But to this day, that's the reason why we keep that account there. And he told him that story. I don't know. I think they contacted us like a couple of years ago or something. And he told the story. He was like, you guys never gave me any problems. You handed me the money and got me through my school. And, you know, that's the reason why I was able to go to college. And that guy was like, that's really cool. I'm like, see, there you go. You just think you're a banker. All right. Any questions on bank reconciliations? Okay. Oh, hang on. No, I need to play with one more or a couple more examples. All right. So on this one, so think about what we just did there. On this one, we wrote the check for $300, but we recorded it at $30, right? So then we had to reduce the balance, okay? What if we trying to think of a good way to put that in the opposite direction. What if we wrote the check for $30, but recorded it as $300? It would be an addition to get the balance back up because we reduced the account balance by way more than we should have, right? Okay? All right. What if it was a $300 deposit that we recorded as $30? Good. We'd need to add $270. You with me? So if we're dealing with a deposit, we put in $300, but we recorded it at $30. Now we need to add it another $270. What if it was a $30 deposit that we recorded at $300? Good. We'd have to reduce it by $270. Okay? So those are some of the things that it's like you've got to be really thinking about. Was it a check that we wrote? Was it a deposit that we put in? Because depending on what we did, it works in the opposite direction. Okay. Don't forget about things like, you know, you could be thrown one where it says the check was written for $39 and we recorded it at $93, right? That's called you remember what kind of error that's called? Transposition error. Good. Okay. So don't let that kind of stuff throw you off. All right. Okay. So the next one says, prepare a journal entry for items A through F from the bank reconciliation. All right. So let's go back to the bank reconciliation. And what I'm going to do is I'm going to hit the snip. And I'm going to pick up our side of the bank reconciliation. Okay. Because again, remember that when you're dealing with this bank rec, remember, those deposits in transit, they've already been taken to the bank. They'll just clear the next day, which happens to be next month. And then these outstanding checks will eventually clear through the system and will automatically update. Okay? So you don't have to do anything with these at all. So the only thing that we're going to be doing something with is these adjustments that we made to the book side. Okay? So the one thing, so let's see, I don't know, which order you want to do them in. You want to run down this list on the right side, or you want to run down the list on the left side? Which way? You want to go right side first? Okay. All right. So it says the bank deducted $250 for an NSF check. We did have to make an adjustment for that over here, right? Don't rethink that whole entire thing, right? We had to reduce cash by $250, right? We know that journal entry has to balance, and we know that we just reduced cash by $250. How we doing? What's the offset? All right, we got a service revenue, we got an accounts receivable. It's accounts receivable. Because remember, when we recorded that, right, it doesn't say we earned revenue or anything. It just says we made the deposit. And now it's kicked back to us. So initially, we removed that $250 out of accounts receivable. Now when the check comes back, they still owe us the $250. So let me go ahead and address this, because somebody always wants to try this one. They always want to put it in some kind of expense. No. Just because somebody wrote us a bad check does not mean that we're going to go, oh yeah, no worries. No. We're putting it back on the books, and now we're going to start bugging the crap out of them. It's like, when are we going to get our $250? I'll take a credit card number today to settle that thing up. You do not want to have, we're going to look at a chapter later where what happens when people don't pay, what happens when customers don't pay. That gets kind of nasty. All right, Nicole's Getaway Spa's written total checks totaling $3,500. Remember, we didn't make a journal entry and no entry for that. That was all on the bank side. Okay. Number 3, the bank added $10 cash to the account for interest earned. So that's this one right here. So we know it's 10 and 10. And we know that we increased cash by 10. Good. Interest revenue. Right, exactly. They're not going to put it into your account unless it is earned. So that would never be an interest receivable. Okay. Oh, gosh. Sorry about that. See, I'm saying it correctly, but I'm putting it in the wrong hole, aren't I? There we go. All right. Number 4. All right. Number 4, that was the $3,480 deposit. Remember, that was deposits in transit. That was over on the bank side, so no journal entry. Now, other things to do as well is over here, right? We can mark these 2 items off because we know we already took care of those. Item 5, bank deducted $10 for service charges. Again, we know it's 10 and 10. We deducted service charges, so cash went down. And not service revenue. Hang on. There we go. Bank charges expense. Now, I will tell you, real world, it's like if your service charges or bank charges expense starts really going up, and you may even, it sounds really nitpicky, but you may want each account or each bank having a different bank service charge expense account. So it's like, so if you've got multiple banks that you're dealing with, you know how much you're paying Bank of America, you know how much you're paying Wells Fargo, you know how much you're paying the credit union, and, you can kind of keep up with who's costing you the least. Because again, I will tell you, one of the things that bugs me more than anything is it's like, I don't like the attitude that people have, that banks have. I'm doing you a favor by keeping my money in your bank. You're not doing me any favors at all. Because I can bank somewhere else. All right, so there's this one. No offense to anybody whose parents work the bank. Or a bank. Okay. All right, Nicole's Getaway Spa wrote a check to a supplier on account for $300, but mistakenly recorded it as $30. So again, we're reducing everything by $270. So we've already got that on the books. We know that cash is going down. Oh, good. Accounts payable, right? Because now, when we recorded that $30, accounts payable, not only was cash reduced by too little, but accounts payable was reduced by too little. Okay? Good. How we doing? You've got to see the little green check marks. I just love that so much. Any questions there? Okay? So again, this whole process of bank reconciliations, just make sure who already knows about it, adjust the other side. If bank knows about it, adjust book. If book knows about it, adjust bank. Yes?
You know the first part of the chapter touched on, are we going to do anything about debt in accounting books? Like, let's say a bank gets robbed. Or your business, I guess.
In chapters 6 and 7, we call it inventory shrinkage. So we come up with a really nice way of saying that somebody's stealing. Okay. Now I will tell you, just a fun note. I nearly got fired from my job when I was in high school. When I was 16 years old, I was a cashier one night at Quincy's, one of those steakhouse places that has the big salad bars. And I grew up in a small town. That was like the best place to work. And they did this whole some soccer club did this whole fundraising thing one time. And I'm sitting there on a Friday night, and the line is just hanging out the door. I cannot even begin to tell you. I mean, I don't think there were this many people in the town I lived in. And the managers were in the back trying to get food out. There was nobody to ask, and I'm like, I got to key this into the into the cash register somehow to figure out how, to give these people change. And it was basically, it was like a little $1 off coupon that I don't know, they had to pay like 50 or 75 cents for, something like that, right? For this soccer club to raise money. I started keying all these coupons in as cash. And so that was, or maybe this was either a Friday night and I came back in and worked Saturday morning, or if it was a Saturday night, I came back in and worked Sunday morning. The rumor had already started. Somebody's getting fired. The cash register was more than $20 off last night. It was so bad. So you have to understand, I think I've been an accountant since I was at least 16, because I was like, oh, God, you got to be kidding me. I walked back into the manager's office and I went, I know what's wrong with the cash drawer balance. He's like, what? I'm like, I was the cashier last night. I know what's wrong with the balance. I said, the amount that you're off is the amount of all those, coupons and stuff that are in the drawer. Now, how they couldn't figure that one out, don't know. They recounted the drawer and went, huh, you're right. Like, that's what I thought. I didn't steal your money. I know, really. It's like, y'all, I'm not taking $20. Let me just tell you, if you ever hear about me taking anything, it's going to be like hundreds of millions of dollars, and y'all are going to be like, oh, sweet. Because I heard last time, that I heard anything about her, she's living on her own island. There's no extradition, and she is living the dream, boy. Because if you're going to do it, you might as well do it big and just go home. Because all this crap of stealing small amounts and going to jail for a felony and then ruining the rest of your life, that's for the birds. There's no reason to do that. All right, let's take a look at the next one. Now remember, we're still on cash. Okay? So if Nicole's Getaway Spa also had $120 of petty cash. Now remember what petty cash is. So let's talk about this. Petty cash is basically, bless you, a small amount of currency that we're keeping in-house. Okay? So back in the day when I worked at a construction contractor, I actually kept the petty cash box because periodically, we sent guys out all over like 6 counties, and they would fix HVAC, plumbing, sheet metal, all kinds of stuff and everything. And sometimes the closest place that they could find that had the part, right, we didn't have an account with. So he couldn't walk in and get a part and say, put it on our tab. He would have to give them his credit card and get that item and then come back to the office, give me the ticket and say, okay, I'd like my $10 back or whatever it was, okay? And I had a little box at the office that it's like I took that invoice, put it into the box, and then I gave them currency out of the box. You with me? So there's your petty cash. All right? So there's $120 of that. And then we've also got $1,000 invested in government treasury bills purchased in August. All right? Now, a couple of things on this one. Don't miss this. What's today's date? December 31. So we purchased T-bills back in August. So that's August, September, October, November, December. That was 4 months ago. You with me? Now, here's the question. What's a treasury bill? Not a bond. There is something different called a treasury bond. Do what? This is going to be the one time that I'm going to legitimately let you do this. You ready? Google it. What is a treasury bill? It's government debt. What's the specifics of a treasury bill? Okay, does everybody follow that? So it was issued in August, 4 months ago. At most, it's going to be paid out in August of next year. So how close are we to it paying back out? 8 months. Okay, all right. Now follow my logic here. All right. So it's 8. Is everybody with me? You're 8 months from getting that amount for that treasury bond, or see, now you got me thinking bond. Treasury bill back. You're 8 months. Now, here's the question. Think, one of the things that we did in this chapter is we started dividing up that asset side of the balance sheet a little bit more in detail. So here's the question. Is it a long-term asset or a short-term asset? It's short-term because it's less than a year, right? Okay, so now we know that it's going to be up here under current assets, right? Now we have to answer the question, does it just stay as a separate line item under current assets, or is it what we call a cash equivalent? Why is it not a cash equivalent? Good. A cash equivalent has to be 90 days or less. You with me? And it's 8 months. So it is a current asset, but it is not a cash equivalent. If it was 2 months from maturing, then it would be a cash equivalent. You with me? Okay. So when we're looking at this and it says what is the amount of cash and cash equivalents on the Kohl's Getaway Spa December 31 balance sheet, do we include the $1,000? No. Do we include the 120? Yes. If we put 120 in that box right there, is that going to give us the right answer? Because keep talking. Let me ask it this way. Is that the only cash that we have? What else do we have? Oh, there you go. So don't miss something like this. You're going to see this one again. And I get a lot of emails on this one. You ready? The checking account says we have $54.80 in it. So $54.80 plus the 120 is... Oh, wait a minute. 56, right? How we doing? See, that's one of those things where it's like, you get to that question, and I know how it works. It's like, get the answer to this one, purge. Get the answer to this question, purge. Get the answer to this question, purge. But you have to remember that this is a multi-part question, so they don't want you to forget what happened in the previous step. How we doing? Okay. I think, yep, that's the last one. We're pretty close to 2:45, so let's go ahead and let's take a break for 15 minutes. So what, 2:53? Let's be back in here.